Let's get a wider read on the markets this morning. Joining us right now is Sri Kumar, who is president of Sri Kumar Global Strategies, and Eric Schiffer, who is chairman and CEO of Patriarch Partners. Sri, let me start with you on that. What do you think about what Paul Tudor Jones just said? The idea that there are probably going to be some really scary moments in corporate credit. What do you think?
Becky, I think there are going to be lots of scary moments. The debt has built up substantially since the financial crisis of 2008. We have maintained ultra-low interest rates for too long a period of time. We had not just QE1, but QE2, QE3. And now we are trying to go the other side and increase interest rates. So the Fed, by excessively easing first and increasing it and causing the debt to increase, which is, I think, Paul Tudor Jones's point, is increasing the risk to the global economy and markets. So I think I'm very much in line, and that's what I've been saying repeatedly on your program, and that has implications for investors. It is not good for equities, and it also means that U.S. Treasury yields at about 3.11 are still too high compared with where they should be.
So we always talk in times of excess from the Fed, the excesses that build up during low rate structures. You think it's the corporate debt market that really is going to be the big bubble that potentially bursts?
There is a bubble everywhere. There is a bubble in corporate debt. There is a bubble in consumer debt. For instance, auto loans have increased substantially. Credit card debt is up. And mortgages are so high, which is why you see mortgage applications falling off. And we had a very bad latest month in terms of home sales. So it is becoming generalized, and that is what you see in the stock market correcting and the bond yields refusing to go up.
Eric, I know you think that there is more volatility ahead when it comes to the equity markets. Is this the underlying reason, or are there other things that you're watching too?
I think that this is a big component of it. And certainly, I think that we're facing, because of the slowing down, certainly outside of the United States, what could be pretty catastrophic for corporate debt and some of the other pretty large mammoth debt burden that exists out there. And I think it's going to be very ugly. Much uglier than perhaps Tudor Jones is even talking about. With respect to the markets, there's this underlying battle that's happening, and the battle is occurring between the fact that you have this slowdown outside of the U.S., you have the debt issue, you have the markets trying to wrestle with, certainly here, what's going to happen with respect to the Fed and the aggressive stance that the Fed has, and I think the market's still trying to line its perception there. And then you contrast that with what's happening in terms of the public's perception in the U.S. of the economy, which is still very positive.
Right.
And those factors, including the fact that we may get infrastructure, that will continue to create volatility. I think this contrast of these forces.
Hey, Sri.
And so it's going to be an interesting time for investors.
Hey, Sri, the question that I'd have, though, is who is holding the bag? Meaning, who do you think is the most exposed, and sort of how systemic is this?
It is systemic, Andrew, in the sense that you're feeling it throughout. And as to who's holding the bag, who's going to be the one which is going to get burned, I think it is going to be a repeat of what happened in 2008. You had the equity holders who thought that the economy was in very good shape until September of 2008. The stock market was running up in the first half of 2008, even after the bond market had given the danger signals. So the same thing seems to be happening again. So the bag is going to be left holding in the hands of equity holders who still have a lot of optimism. They are going to be the big losers, Andrew.
Let me ask you this. You touched on this briefly, Eric, but just the idea that it is still a very strong economy in the United States. The job market looks unbelievable. And if you talk to the CEOs of any banks, generally they can see things in the 18-month horizon. And every single one that we've talked to has said that they don't see any downturn or recession in the next 18 months. How do you explain that, given the huge concerns that a lot of people have and the slowing that we're seeing in some areas?
Well, I think I don't necessarily disagree with that time horizon, but what I think presents some concerns and serious concerns are, these arguments that I think have put forth with respect to the debt market and some of the corporate debt that exists as you see slowing down outside the U.S. Whether the U.S. is going to be able to continue in sort of a vacuum over this time period, we're going to find out. We'll see. We'll see what happens. I'm optimistic over the next year. I don't know that we'll see it extend all the way, but if we're going to find out, we're certainly going to see. But I think investors need to recognize that there are some very serious risks today that that just have not been in existence for some time. On the equity side, I do think that there will be concerns when debt gets hit. The equity markets are going to have a similar impact, and there will be adjustments there as well.